today's topic clearly is finance for technology executives. That's the objective. In fact, I'll go ahead and share my screen and get that rolling. Philip is my trusty partner as we keep going through this. So, Philip, thank you for running the administration of what we're doing.
You bet.
And Victoria Wissett is with it as well. Nice to see you.
Hello.
Philip, you do a great job of introducing AKF partners. Would you give these guys a sense, if there are anyone who's new with us, just a sense of what we do and how we do it?
You bet. Yeah, for the folks that are new to AKF, and if this is your first webinar, the founders were Marty Abbott, Tom Keevan, and Mike Fisher. They were at eBay and PayPal. Two of them actually go back even further, back when they were actually undergrads together and grad students together. They were at eBay and PayPal right after those original founders cashed out, like Elon and Pierre, and they helped scale those companies. They all retired around 2009, actually a little before that, and helped companies scale, and also helped older companies transform. At the time, older companies such as Adobe and Intuit, and then helping younger companies like Salesforce and even AWS at the time scale up. So those principles are what we've used. We're all about that same age cohort. So we are all pre-internet folks when we entered the workforce, and we'll weave all that into our conversation. So we help companies, and a lot of you are worked with this. We either will, for startups, we typically do due diligence. For older companies, we help unwind some problems and help solve architectural and product challenges. So we're glad you're here, and thank you for taking advantage of our free workshop. These used to be on site. They used to be in person for 2 days. And so it was a lot of material to cover in a short amount of time. And then we would have 3 long follow-on sessions. So we're breaking this over every 2 weeks. We'll record these, but love to have you engage, and any one of you can talk or ask questions in the chat. So
Please do. The interactive nature of this is what makes it so much more fun for us and much more engaging for you.
yeah. And good question on the chat. You see there?
No, I
Yeah,
can't
we've
see
got
it.
Well, we need to get the slides out from the last session and the recordings. There's already folks that are
We
asking
do.
about those. So
I will apologize. I am the guy who does all of that, and I've been absolutely gang tackled with work in the last couple of weeks.
we
So
will give you your money back if we don't do it.
it'll be out there. My intention is Monday. I'm heading to Dallas for Thanksgiving. So Monday and Wednesday of next week, I have very free. This will all be not only this one, but the one we did last week, 2 weeks ago, sorry. Guys, I am your presenter for today. My name is Doug Baden. I am an AKF partner, associate partner. I've been here for almost 3 years, coming up on 3 years. My career has spanned 30 years of enterprise IT, primarily in the supply chain space. 1995 until 2025. A great majority of that time was done in ERP implementations for large industrial manufacturers. So my experience base is a little different than most of the AKF team. I do not have a development background. None of that really matters for the accounting side of what we're going to walk through today. My background in that is primarily with on-premises, but I've got a good bit of experience with going into the cloud-based services that we are all very, very familiar with as we go now. Our topic today is accounting for technology executives, and a very easy and simple question. Why is this important to a business? Why do you have an accounting group? And the simple thing is you've got to match the costs of the goods, or in most cases, the companies we deal most clearly with are delivering software as a service. So it's not necessarily a product, but it's the service and either a subscription cost, but there's some level of revenue that comes from the delivery of a product or a service, and this is a means of accounting for that. There are a number of basic financial statements that are very important for us. A successful CTO is going to understand and be very, very conversant in the language of business. The key letter in CTO is the C. You're in the C-suite. You've got a chief technology officer role, And by that, you've got a budget for which you are accountable. There's an opportunity to be a very clear partner to other C-level executives. You bring the technology that gives them the capability to do what they do, but you also use the information that you've got, the knowledge that you have to be able to empower your team with financial resources to be able to do the things that you expect and need for them to do. There are three primary financial statements that are used by public companies. And this is a point of input from you guys. Can you give me what you think are the three primary financial documents that are used in any business?
You can answer in the chat. Oh, Christopher raised his hand.
Oh, I
Go
can just
ahead.
tell you.
Yeah,
Would it be cash flow, income, and balance sheet?
You win. Christopher, fantastic.
and Nicholas was right in about the same time.
Oh, sorry.
Good job.
Thank
No, you're good. You guys did great. First channel in wins.
The first element is the balance sheet. And there are significant elements around it. The income statement and the cash flow statement are also, these are the three primary elements. These are elements that are necessary. They're required by GAAP standards to be reported on an annual basis. And there are updates that come from large companies on a quarterly basis. Privately held companies have additional requirements. Some of you, if you're a startup, that may be very relevant for you, but the primary three elements are the balance sheet, the income statement, and the cash flow statement. And that's where we will spend the majority of our time, at least for this next 30 to 40 minutes. GAAP standards, generally accepted accounting principles. These are the standard working documents and the processes for all of your accounting. Any of the budgeting that you do, any of the activities you have within your organizations all fall within this same GAAP level of activity. They're intended to level the playing field to make sure that businesses are working on the up and up across everything they're doing. They've got a standard set of practices and reporting that make sure that competition is well founded. It also makes sure that you've got good financial controls across your company, and you're, in this case, very, very clear protections for the consumers as well. Very simple accounting equation. You've got assets, and that is equal to the liabilities that you hold and the equity that you hold. Equity is broken down a little more clearly into the capital, the dollars, the amount, the physical assets that you hold, the physical cash or the available cash, and your retained earnings. There's another level of detail, and this is probably the area where I spent most of my time. Your assets don't change, but you get a very clear sense of what your revenue is, what are the expenses, and what are the dividends that we're providing to our investors. Those are the elements. This is the primary building blocks for the financials that your financial professionals work with, and you need to understand as well. Those have very clear representations. Assets are cash, physical inventory if you have products. If you've got accounts receivable, you've sold something to someone, and this is a place where even a service would be relevant. If you've got dollars that are coming or expected to come into you based on a contractual agreement with you have your customer, that is a receivable. You've got some prepaid expenses or physical equipment. Those are your assets, the things that show up on the plus side of your balance. You also have liabilities, things that you owe. Every business has suppliers, and to those suppliers, you owe money. You may not pay it right away, but you keep track of what you owe to them based on your usage of their services or their products with accounts payable. There are also notes payable. Those are things that you're paying off on your existing debt. There's also deferred revenue in some cases where you're not expecting to have the revenue come in from a customer engagement right away. It's planned to come at a later date. You keep track of it within your liabilities. Capital is those elements that come in from your owner. If you've got an investment firm or if you are a self-funded company, those are the elements that come in from the owner of the company. Revenue is pretty simple. That's our sales. It could be in terms of physical sales if you sell products. It could be in services revenue, service fees, subscription fees. How many of you guys at this point have a subscription for the services that you provide, and that's your primary source of revenue? Expenses are also relatively easy for us to understand. Wages, that's the amount of money that is paid to the people for whom we owe allegiance for their work. Cost of goods sold, that's the physical costs for the products that we sell, the cost for us to manufacture them, if it's a physical product that we're selling. If you're selling a service, it is the cost to produce the service. What infrastructure, what number of people are required to actually produce the revenue that's coming through. We also track rent expense or capitalization. If you've got a physical building that you occupy, that you own, that has a depreciation schedule over maybe 20, 30 years, and you take a portion of the value of that building over the course of those years. Advertising expense, professional fees, you can read those as well as I can. Those are the normal expenses. In fact, most of you probably are very familiar with those as you put together a budget. You see those expense lines on your individual profit and loss statement for a department. The balance sheet is a formal presentation of those assets and the liabilities and equity at a specific point in time. This is not expressed over a period of time. It is a balance sheet is a one-shot job. You're looking at your current immediate assets and liabilities converted to some level of common cash or some value that is equivalent across the immediate time frame. So you're looking at the next 12 months or so. The strength of the balance sheet determines what your value would be to an investor or to anyone who's interested in acquiring your company, if that's a place where you are. The inverse also balances that way. If you've got a balance sheet that shows a high level of liability versus your assets, that is, from a company perspective, that is not as appealing for an investor. Balance sheet also gives us an opportunity, and this is one of the places where one of our colleagues, Greg Fenewald, would very commonly go through and talk about a repo. Because a balance sheet is a single shot in time and it is a representation of the value of your company, it gives us the opportunity to shade the truth a little bit. If I have a stressed asset, if I have a loan, for example, that is outstanding, I can sell that loan to my buddy, to someone else, and it disappears from my balance sheet for a period of time. So I could ask someone, and this has actually happened, I could ask someone to purchase that loan from me for the period of time where I need to report my balance sheet. So my balance sheet looks great because it is a point in time. And I'll promise that in 2 weeks, I'll pick that asset back up. But you've given me the opportunity to reflect a better balance sheet than is in actual truth. This is a more specific look at the balance sheet. Cash and equivalents, those are the things that are actually in the bank account. Short-term investments, accounts receivable, those are the things that for my customers, they owe me the money based on the services or the goods that I provided. Inventory, physical inventory that you hold. My experience there is that was a significant amount of the asset that we held for the companies where I worked most of the time. We were in a supply chain business, so we sold physical goods, and I had warehouses that had anywhere from $30 million to $65 million worth of inventory sitting inside the building waiting to be sold. Prepaid expenses, a number of other things you can look at as well are physical property, the land, the buildings, the assets that we own as a company. And then you get down into goodwill. We'll talk about this a little bit in the future as well, in terms of how it helps you manage the balance. Goodwill can be a representation of a financial transaction that allows you to keep a good solid balance, knowing that you've got goodwill going towards the assets in the future. Liabilities then are a little different. Short-term payables as opposed to receivables. I've got money that I owe to my suppliers. I may not have paid it yet, but I know definitively what I owe to people. I have my loan payment, my long-term debt payments that I take care of. I have other liabilities that I may have accrued over time. I also have long-term notes that I keep track of all of my outstanding debts in terms of notes and bonds. And then I maintain some level of accounting of my common stock. If I am a publicly traded company, I may hold some of that stock myself. The element here is that a balance sheet is indeed a balance. The intent is to have the exact same amount, the exact same dollar amount for your assets and your liabilities on each of your balance sheet elements all the way through. Questions or comments?
Quick question for the audience. I hear Charlene's asking about dividends. Curious about dividends. How do these get calculated? Do they only apply for public companies, or is this form for non-public companies as well? Yes, it can be for non-public companies as well. Dividends were a lot more common 100 years ago or 50 years ago because we didn't have the same kind of capital markets where it was easier. So the idea was you would pay back your investors, and you would recall that liabilities come first. So the bank holders, if you have a loan, they come first. And once you pay off loans, then your shareholders are next. So a dividend, though, is more like a commitment, though. It's not as committable as a loan, but it is a commitment to your shareholders. So, Brian, why do assets need to equal liabilities?
Simply
that is the
because it is
basic-
a balance sheet.
Yeah. It is the balance sheet. Well, it equals assets equals liabilities plus equity. So when you take an accounting class, you're always you calculate the equity last because everything else is easy to add up. You can add up assets, you can add up liabilities, but that's the difference there where you determine what your equity is. So it actually equals assets is equal to liabilities plus equity.
Yep.
Good question.
The equity is the value of the company overall. This is what I owe, this is what I have, and this is the difference between them. Good. All right, let me get back where I was.
Just a quick question. Does anybody actually, any of the attendees, are they paying dividends to shareholders today? I would doubt that. You typically see for newer companies, it would be more on the real estate side. You might see more dividends. That's more common.
All right, let's go to the next financial statement, the income statement. This is a scorecard over time. This is your profit and loss. In fact, in common vernacular for me, I didn't deal with an income statement. My financial department, my accounting groups talked about a profit and loss. Even though I was an IT department, I didn't have a profit, I didn't have revenue. I looked at everything that I did as a P&L. I was given an amount of money at the beginning of the year, and I spent that through the course of the year. For me, it was a zero-based balance, but this was the mechanism. The income statement is the mechanism that I used to express my financial statement all the way through the year. There's a number of elements in it. Gross profit is the overall amount of money you make minus what it took for you in terms of costs to generate that revenue. Am I making my widgets profitably? Do I have a pricing structure and a cost structure that makes sense for us so that we actually make money as a company? The next piece then is gross profit minus the operating expenses. What did it take for me to run my business? This is not the cost of what it took me to produce the good or the service, but what are the sales costs, the marketing costs, the building costs, the other elements that are necessary for me to be able to produce the goods or the services that I provide. Net income then is the operating income, that second element, that second bullet, minus the interest expenses and the taxes. Our expectation with most technology teams, most of the guys who are probably on the phone with us today, is that your costs are normally going to show up in operating expenses or in the cost of revenue. And this is a point where I'm looking for some input. Where do you see your costs most commonly fall? In operating expense or in cost of revenue?
I often feel like a lot of my I'm in like a small technology startup company. I feel like I always lump my costs as I'm managing the technology section under like operating expenses, but I do feel like a lot of times um the CFO I work with often looks at it like that, but rolls it up and like I guess she calls it like cost of goods. Would that be similar to the cost of revenue
Yep,
or a little different, I guess? So I feel like it's like
exactly.
a disconnect sometimes. And not to say that like she's doing anything wrong. I'm just I'm sitting here because I'm trying to make sure I can work with her and speak to her in her lingo better. But yeah, I feel like I always try to budget my stuff or look at what our operating expenses are from a technology standpoint, but I feel like it gets rolled into a different mechanism.
That is exactly the element we're looking for you guys to understand. The operating expenses in some cases are, as we listed here, software development. The the people that are necessary to produce the software that produces the revenue for the company. The infrastructure, the AWS costs, some of the other elements might be in the cost of revenue where I've got a production environment. If you've got an on-premises data center where you're actually producing the software that you sell, the physical hardware, the cost of the facility, the cost of the hosting, and the people that manage and maintain that, they're not directly tied to the software itself, the revenue producing software. That would be in the cost of revenue. So there's an element there, and that's one of the key differentiators we want you to understand is how you can become a partner for your finance crew to make sure that you account for things accurately to the best benefit of the company. CTO can improve the operating margins. In many of our software companies, the IT department, the development department, the engineering department is likely the largest department, the largest contributor to the costs based on the overall salaries and other expenses necessary. You are in a key position then to be able to influence the profitability of the company by properly working with and partnering with your financial organization to make good sense of how they maintain and manage their accounting.
No, we have a question in the chat. I think we're going to wait and answer in a bit. It's asking does cost of revenue equal cost of goods? And I think we'll get to that in a bit.
We will. Not necessarily. There are elements of
Yeah.
it where they are equivalent, but they're not directly equivalent. Let's look at an example of an income statement, and this is going back into the way back into 2012. If you guys remember when the iPhone was first coming out, BlackBerry had come out with the enterprise email systems long before. In fact, I know this very well. I was a BlackBerry devotee for many, many years myself. We were the first BlackBerry enterprise server in the Los Angeles basin in my company back in 2002. So I was fully committed to it, and I wept when BlackBerry started to die. We're seeing here where they started to die. Look at the revenue. 11 billion in revenue in 2012. That was cut by half to 6.8 billion, sorry. And then once again by a little more than half in 2014. So they started to experience the influx of an iPhone revolution that continues even today. The income statement here is showing over a period of time what it costs for them to produce the revenue, what their overall gross profit was. 60 billion, that's way less than it had been. 3.4 down to 60. And it never really recovered, as you guys are very, very aware. BlackBerry is no longer even a going concern. Net income at the bottom gives you a sense of what their cost structure was. For the revenue that they had, their cost structure was wildly out of gate for 2012 and 13 as they were trying to react and reel from the impact of the iPhone on the overall market for smartphones and the capabilities of mobile email, which was the primary push at the very beginning. Cash flow statement shows the change in the cash position for an individual company. And the key thing you're looking for there is your liquidity. How much cash do I have available to me to continue to operate? Solvency is another important element, but the liquidity is probably the more important piece that we wanted to highlight. There are two different ways of managing and maintaining your cash flow statement. The indirect method is the most common. The direct method is also a possibility, but in most cases, because of the nature of the financial systems that you have, an indirect method of understanding your cash flow from operating activities, from the investing activities and financing activities is much easier and more easily manageable for your financial organization, for your accounting group.
And do any of you know why that is? The idea here is that it's more forward-looking. That's the attempt here. That you may like accounts receivable. You expect all this money coming in, but it hasn't come in yet. So if you only waited until the money came in, you would be lagging a bit in that situation. Same with financing. So you're trying to give your shareholders a better sense of the next period and the prior periods. So it's giving you a little bit wider time view, even though it's a cash flow statement. Yeah, Reginald said, yeah, your earnings are always lagging, so you want to know when you'll project income.
Projecting income, precisely. Yeah. Good job. There are times where a company is going to face a liquidity issue, and you may actually consider it a pressure. That's one of the pieces that we wanted to walk through as well. A CTO is uniquely able, in some cases, to be very aware of what your liquidity position is, because in several cases, you've got an opportunity to buy or lease either equipment, or you can also look at that in terms of people. You can bring in contractors, or you can bring in full-time employees. It's not the same as a buy or lease, but the impact on the financials may have some of the similar impact as you go through it. You're looking for financial actions around financing, investing, dividend payments, etc. They're not normally the core proposition of what the company's doing, but the income statement is showing your overall revenue and your expenses, and that has exceeding relevance in terms of what you're looking at for the cash flow statement all the way through. Accruals are another element that we look at. If you know that you're going to bring in new revenue, you can begin to set up a series of accruals. I generally dislike these as I was a VP of IT, but they're a financial tool that gives you a sense of properly showing what your income will be, and then recognize that cash flow as it comes in. The cash flow does not show the cash as it should until it's physically received. So you've actually got it, or it's been dispersed from your customers. Let's look at the cash flow statement then for BlackBerry over the same periods of time as we looked at for their income statement. The net income, wildly different. Depreciation, you can start to see some of the shedding over the course of years of the physical buildings that they were in. BlackBerry started to get rid of some of their physical assets. They got out of some of the buildings that they'd been in. Changes in working capital went from 487 million to 1.259 million, down to 59 million, so that you can see the impact, the wild jumps up and down for BlackBerry as they were going through this very significant, unexpected disruption to their business. Net change in cash also from a positive to a very significant negative over the course of 4 different years as we're looking at this, 2012 to 2015. Another element that we're looking at is the financial ratios. 2 ratios we're looking at primarily. The current ratio, which is the assets divided by the liabilities. And from a ratio perspective, if they've got assets in excess of their liabilities, which you can see here, they were a ratio of 2.15 down to 2.14 up to 3. It looks as a leading indicator, it looks like BlackBerry is a good company in which to invest. Apple, on the other hand, that was their direct competitor, was at least somewhat consistent, 1.5, 1.6. So their assets were more closely in line with what their liabilities were. There are reasons for that. The gross margin is the place where I probably would focus you. Gross margin for BlackBerry in 2012 was 31%. That went down to 1% in the next year. They made some significant changes, and we showed you some of those significant changes here in terms of what their assets were that gave them the ability to manage their gross profit back up to 49%. It fell again to 46%. At the same time, look at what happened for Apple. Very consistent, 44, 38, 39, 40. So Apple was managing their overall financial position much more clearly to give a much more cognizant sense of what they were doing for their market and for their investors. Philip, I'll bounce it to you to see if you have any additional elements you wanted to walk through. This is a place where you have a little more experience than I do.
No, I think the main point here is that until really the internet took off, that these were very common ratios that more passive investors would look at, but it didn't really show the real story. And that was a real tipping point back around this time period, late 90s, early 2000s, when you had to look at technology companies different versus these traditional ratios. So that's the main thing. Now, most investors are more sophisticated and have different metrics that they're looking at. So.
As a CTO in a publicly traded or a private company, contrast yourself with BlackBerry or with Apple. They're physical device manufacturers. Yes, they sell software, but they also sell the physical device. You have, because a software as a service company, you have a much larger impact on the overall gross profit and gross margin simply because you are probably one of the largest, if not the largest department. You're the largest source of cost to produce the service or the good, and you have a significant ability to influence the gross margin all the way through. How many of you guys are closely managing and monitoring what your gross profit is month to month or quarter to quarter? And conversely, what your impact is on that gross margin in terms of the cost that you bring into the revenue that you bring?
I feel like I track all our expenses from the technology standpoint, like as like to the penny almost. Not obviously not to the penny, but that closely. But we don't really go over these traditional statements, I guess. Like our CFO kind of has a different mechanism. And I guess my question is like, I like we were going through a bit of a crunch because we work a lot, our services a lot with the biotech and pharma industry. So we obviously go through those ebb and flows when they go through those ebb and flows, being that we're kind of like more of a nice to have service for some of the departments there. So we were kind of going through a moment of austerity this past year where we were really trying to cut back things. But yeah, but we never really go with these like traditional statements. So I guess my question or thing with that is like, I guess is that does that put us at a disadvantage, or like is that something I should talk to my leadership team?
No, I don't think so. Most likely what's happening is that your CFO assumes you don't know these statements, and so they're already doing translation. So remember I don't know if you did the previous class, but we talked about this business technology gap. Well, even this is a bit of a language you have to learn. And so CFOs have tried to simplify that to just focus on what you can control and how do you impact that. But they're going to work with you and have to, in turn, they still have to create some of these statements for their investors or for your investors. At some point, investors will want this. If you're a small startup, you may be okay without this, but usually if there's any kind of exit event, you're going to have to provide these financial statements, not just to do your taxes, but whenever you're going to sell the company, you'll need this. So they're translated in their head, and that's where there's a risk of translation error, of mistranslation, is how you explain it to them, and then they in turn report on it. So that's where.
Christopher, if I could ask, do you have a clear sense of what your department provides, what your people provide in terms of how it influences the revenue against the costs that come in? Can you have that conversation with your financial department?
Yeah, yeah. Like I said, we're really small. I'm actually one of the co-founders. So
Okay.
so we're about like, 20 individuals. Which to both to your point as you shared earlier, it's like a technology-led service that we offer. So we are the majority of the operating expenses just from just producing the analyses and stuff that we do, and then also just like I'm sure you're familiar, as a small tech startup, the technology team is also the IT team. So
Yes.
we manage all, like, so I'm managing all those kind of like, information technology, information security type budgets, and then also just our technology, like our software, our R&D, because it has a very heavy NLP/AI component to what we do offer. So I do track it closely with her, to get back to your initial question. And I have a pretty solid sense on what the impact is. As I was saying earlier, when things were getting tight, and it goes back to your liquidity issue that you brought up, I really tried to start scaling back some of our expenses. But the big expenses that we do have is it's like people, and to a lesser degree just machines, like, computers for people to work on, and then our
Correct.
our cloud service, our cloud we're all cloud based, so our cloud expenses, sorry.
Your ability to become a partner for your financial organization is one of the keys we're trying to get you to understand. There's a tremendous amount of power that you can bring in that respect. I'll give you an example. I was with a medical device manufacturer for many, many years, and we had a need at that point. Believe it or not, we were still building physical servers. This is before the age of cloud, so that gives you a sense of how long ago some of the things I've been doing. Um, I could represent the cost of a new server. The server gave us the capability of providing additional testing for the medical devices that we were building. It came with a very specific cost. The difference for me was the ability to share the increased revenue that would come from the introduction of a new server that gave us the ability to do more significant or more speedy testing. So I had an immediate ability. I sat down with Ed, my finance guy, and we built together an independent rate of return spreadsheet that I used to justify my projects for the rest of the time that I worked with him there. It was a financial document that he understood. I provided the inputs. Here's what the costs will be. More importantly, it gave him an easy means of relating it directly to what the outputs would be. What would revenue would come from the inputs that I was going to provide. The ability to partner with your financial organization at that level gives you a tremendous amount of ability to relate specifically what your value will be to the organization and your organization all the way through. That's part of what we're trying to convey. The financial instruments, the cash flow statement, the balance statement, those are the tools that the financial professionals use, and that's what we want you to understand. Philip mentioned this is a technology gap. Our ability to meet and find the financial and business professionals on their terms is what we encourage you to continue to work towards. Most of us, if not all of us, come from a technical background. We need to learn the business so we can convey our value to them in terms that they understand.
Great, thank you.
Okay, I kind of bled into this already. Know the rate of change of depreciation. If you've got physical hardware, if you're depreciating that over the course of 5 to 7 years, know what that value is. Um, this is not as true now because so many of us have gone into the cloud and it's much more of a monthly or a quarterly expense. But knowing what your depreciation is for software, physical hardware, that gives you a sense of managing and maintaining your operating expense over time. Cloud services make it a whole lot easier for us to trigger or understand the outputs from our financials to the inputs of revenue. But you may need to be able to illustrate, same thing I was just talking through, illustrate, here's the cost of an increased cloud-based service, and here's the expected revenue that would come from it. And there should be a profit that comes with it too. Spend commits, if you've got technology products, that you're purchasing. You've got subscriptions. Understand what the subscription is and the number of years that are necessary for that, the payback. Once again, in many cases, you're not buying hardware anymore. We allow or provide our cloud-based services to buy the hardware on our behalf. When I was buying hardware, in many cases, the vendors would throw in the prepaid maintenance, and it sounded like a great idea at the time, but that is money out the door at the moment you make the purchase, and it doesn't necessarily reflect positively on your cash flow statement. So be aware of the significant impact that technology has on the overall income and the cash flow statement all the way through. I made several choices to lease equipment instead of buying it. Leasing is a monthly expense. The benefit is that you can much more clearly spread that cost over time. There were times when this is one of the things that we worked through with the IRR spreadsheet that I mentioned to you too. We would look at the lease cost versus the buy cost and make a conscious decision on each project whether we would lease or purchase the hardware necessary to do the project. Those are simple conversations that your finance guys in many cases may not be expecting you to have, but knowing that you can have that conversation and give them the tools to manage their expenses in ways you may not be immediately aware gives them a tremendous amount of benefit from having you there as a partner. Accrual accounting, hiring employees versus contractors. This is probably one of the more significant areas. Contractors may be more costly in the immediate term because of the hourly rate that you pay for them, but they don't come with a lot of the additional burden, the benefits, some of the other elements. So being ready to have a conversation with your finance organization, you need the resource to do the work to generate the revenue. You've got some really good controls on how you manage that. Is this a resource that I need for the long term? Likely then it's best to look at a full-time employee. If you've got a very specific need for a short period of time, a contractor can give you that flexibility and the relief without having to go for the longer term expense of bringing on an employee. Your CFO is going to be your benefit. They will appreciate a CTO that can have a conversation with them on business terms. That's the primary element that we want you to understand. All right, a number of key takeaways. Make the CFO's job easier. Your awareness, your willingness to engage with them in the conversation that they normally would deal with, that gives you a significant feather in your cap. Be the poster child of your company. They typically understand the cost of inputs. The accounting people are looking at the costs going out. They understand what it costs to produce the revenue a little more in some cases than the way that the revenue is produced. They certainly see the revenue, but they're looking at cost accounting. That is the primary area where most of them will focus. Agile has shaken up a lot of the traditional cost accounting. There's a significant amount of effort that financial engagements have put into capitalizing human resources, for example. If you've got people who are working on a project, there may be a desire through some of the ways that we've traditionally taken care of spreading those costs over the course of years and minimizing the impact on an immediate cash flow. There may be a desire to capitalize human resources. That conflicts a little bit with agile adoption. Know the difference, understand the ways you can account for people, the human resources that are working towards the revenue generating processes you have. Be able to speak to your CEO or the board about how the tech spend, what you're putting in when you're asking for more resources, you're asking for more people, how does that impact your ability to earn revenue? And then this is really the bottom line. Understand the inputs and outputs for your organization and how they make a difference for the companies all the way through. We would always recommend, if you have some questions about any of these things, there's a couple of resources we would point you to, and this will be available to you. We'll send it out in the email to you. These are both really short books. They're very easy to understand, but it gives you a tremendous leg up I can almost guarantee you that your CFOs are not looking at a Python programming book or how to understand the technology. You have the opportunity to become their partner by understanding their world and coming to meet them on their terms. Philip or Vic?
No, we're getting low on time. We have some other content we had to cut from this, but there's probably a lot more questions that you have, and we've got some blog posts on some of these. So feel free to reach out directly to us. I think you have most of you have our email addresses. If you have specific follow-on questions, a lot that we get to are how to deal with CapEx versus OpEx challenges there, how to deal with hard costs versus soft costs, and then maybe even more advanced ones of, as you get into more advanced cloud services, really understanding spot pricing versus flexible pricing. So the more that you can understand those and explain those to your CFO, the better. So just keep in mind that the systems they use to run their job they are accounting systems, and it's hard to force fit technology into some of these accounting systems. So that's why there's a lot of translation needed by you in order to explain this, and ultimately gets recorded though in those 3 financial statements that we talked about. So
Thanks, guys. It's great
all
to
right,
have you with us.
Yep, next week I believe is technical debt. So that's the
Correct.
next session, and it's more just technical debt. It's actually explaining technical debt and hidden costs to others and getting them to pay for it. So
Thanks for
all
being
right.
with us, guys.
Thank you. Appreciate it.